U.S. nat gas futures fell to $2.50 in the third week of July, following 3 consecutive weeks of declines as maintenance work limiting the gas flow to LNG export plants and rising output more than offset expectations of higher cooling demand. Although gas flows to major U.S. LNG export plants have risen in July, they remain below record levels of 14 billion cubic feet per day due to ongoing maintenance at various facilities. Also, gas output has been on the rise and is on track to top the monthly record high of 102 billion cubic feet per day in May. Looking ahead, meteorologists are predicting temperatures above normal until July 29, which will drive up the usage of natural gas for cooling purposes in homes and buildings. The theme this summer is for impressive heat in the 10 to 16-day period to trend cooler as they roll into forecast days 3 to 9. Meanwhile, the total number of rigs in the U.S. continues its downward trend, with the count reaching 675 rigs last week. U.S. gas production has outpaced demand, resulting in more natural gas injected into storage midway through the 2023 refill season. Since April 1, net injections into nat gas storage have exceeded the 5-year average by 6%, and working natural gas inventories have reached 69% of working gas capacity so far this refill season. Nevertheless, in the latest short-term energy outlook, EIA forecasts that storage injections will slow because of relatively flat gas production and increased gas use in the electric power sector to meet cooling demand for the remainder of the summer. Starting in November, there is a potential for a rapid decline in the surplus, leading to gas prices increasing as they approach the levels seen in the 5-year average. This anticipated shift could exert additional upward pressure on gas prices. Meanwhile, Europe's drive to hoard gas ahead of winter may have unpleasant side effects. Like good pupils, the bloc's members have done their homework and are on track to fill up their storages well ahead of a self-imposed November 1 deadline. That should avoid a repeat of last summer's mad rally in Europe gas prices. But it also risks creating an incentive for U.S. cargoes of LNG gas to head to Asia. Ironically, the situation could result in a rather unwelcome punchline for Europe's and U.S. gas prices during the upcoming winter season. The market sentiment for nat gas is slightly bearish. It is trading below the 50-day moving average, suggesting potential resistance. A sustained move under the $2.55 level will indicate the short-term selling pressure is getting stronger, with a retest of $2.42 as the next likely target. However, a sustained move over the pivot at $2.55 will indicate the buying is getting stronger. This could lead to a near-term acceleration to the upside at $2.77, the nearest target. Thank you for watching. Please don't forget to like and subscribe.